Hello, and welcome everyone to this webinar on the report by Disaster or Design, which was written by the Arketa Institute. The paper is an introduction to ecological economics and to post-growth thinking. And it's written for financial professionals, for sustainability professionals, and really for all those who are interested in how our economies can work in a post-growth future. My name is Laura Segafredo. I'm Chief Growth Officer at Nature Alpha, and I'm also an adjunct professor at Columbia University, and I will be your host for the next 90 minutes or so. We will do a few brief introductions of the Arketa team. We'll do some housekeeping before we begin, and then I'll hand things over to the Arketa team. All right, so first things first, thank you so much for coming, for joining us today, for tuning in. This webinar will be recorded and it will be posted on the Arketa Institute website in a matter of days. It'll be very soon, just in case anybody missed anything, there will be a replay available. Everyone will be muted for the duration of this webinar, with the exception of our speakers, but you can send questions through the chat function on Zoom, and we will do our best to get through as many of your questions as possible. The report itself is conveniently divided into 3 sections, so each member of the Arketa team will walk us through one section of the report. And then after each one of the presenters have talked about their section, we will allow about 15 minutes for questions on that section before moving on to the next. The Arketa team are Matt Orsagh, Anastasia, Linn, and Steve Rocco. They will introduce themselves briefly now, but you can also read more about them and their bio and their work on the Arketa Institute website at www.arketa-institute.org. All right, so I'll now hand things over to the Arketa team, starting with Matt.
Thanks, Laura, and thanks everyone for joining us today. We'll be very brief so we can have hopefully a robust conversation with you guys through the chat and go through the report. My name is Matt Orsagh. I'm a co-founder, along with Anastasia and Steve, of Arketa Institute. We've had this idea maybe for a year or so, building up to founding Arketa and the report that came out last week. And our mission is really to normalize the conversation about ecological economics and degrowth and a post-growth well-being economy in the financial world and the sustainability world, because we saw that really wasn't out there, and there was a need for it. In each of our journeys, we came to these ideas later than we thought we should have, and we thought we wanted to help other folks get there as well. So I'll stop there and pass it on to Anastasia.
Great. So hi, everyone. Thanks also for being here from my side. My name's Anastasia, and in addition to my work at Arketa, I'm also affiliated with the Center for Sustainable Finance and Private Wealth at the University of Zurich and Degrowth Switzerland. So I'm joining the call today from outside of Zurich, and looking forward to this discussion with all of you.
Hi, everyone. My name is Steve. I'm joining from about an hour away from Geneva in France. My background is in finance, all kinds of finance, from nonprofit financing to Wall Street to banks to impact investing and developmental finance. And I'm very happy to have all you guys join us today. Thank you.
All right, perfect. Thank you so much for the introductions. So now we are going to jump into the paper. For those of you who have read the report already, you will know that it's broken into 3 sections. The first is an introduction to the predicament. And so that section speaks about the limits of our current economic thinking and introduce the concept of degrowth. The second section talks about the role of finance in a post-growth world. And then the third section talks about the changes in our story, in our mindset needed for moving forward with these ideas. So each of the members of the Arketa team will take one section and will walk us through it. And then after each section, we'll pause and we'll open things up for questions. We will be monitoring the chat for questions, and we'll really try to match them to the right section. But we'll also leave time at the very end of the entire presentation to get to any questions that have come up if we haven't managed to address them. If we don't get to your questions, we will do our best to reach out to you after the webinar and answer as best as we can, because we would love to have this engagement continue beyond the webinar. All right, Steve, I believe you're first and you're taking the first section.
Yep, here we go. All right. So I'm here to explain the difference between neoclassical economics and ecological economics. Why do this? Because every financial decision you take, a bank takes, a hedge fund takes, relies on a series of economic assumptions that we usually don't think about. It's so embedded in our DNA from when we were in an MBA program or in the university that we just don't think about it. So given the situation that we're in today with the climate doing what it's done, all the other problems related to the environment, and as well as the massive inequality in healthcare, housing, education, and you can go on and on, we need to rethink what's going on, because obviously what we're doing doesn't work. So where do we start? Science. We start with science. All the things that I'm going to go through today is all based on physics and science. It's not up for debate. It's not if you go to any university's physics department or engineering department, these people are like, yeah, of course. It's not maybe. It's all science. It can all be. You can use a scientific method to test it yourself if you're so interested. So with that, first point is the idea of systems. There's three kinds of systems: open, closed, and isolated systems. Each has a different relationship between how it interacts with energy and materials. Energy can be fossil energy or renewable energy, and materials is basically everything you see around you: sand, cardboard, a tree, anything. Those two elements interact with open, closed, and an isolated system in different way. The key point is that neoclassical economics sees the economy as an isolated system, while ecological economics sees it as an open system. Next, keep that in mind. Next is the laws of thermodynamics. Very complicated stuff, but this is not up for debate. These are laws this is how we build a skyscraper, an airplane, anything is all built on thermodynamics. So it's not a contested idea. You have two laws of thermodynamics. The first one is the conservation of energy and the conservation of mass. For an economic, the relationship with the economy is this idea of the mass balance principle. Basically, in simple English, it's everything that goes into the system has to be accounted for and has to go out of the system. That's number one. The second law of thermodynamics deals with something that's very tricky to understand. It's entropy. Entropy is an idea that has been around for 100 years. Entropy is a measurement of disorder. But from what we're trying to discuss, which is economics, all physical processes, so making an iPhone, making software, making a washing machine, doesn't matter, converts low entropy energy and materials into whatever they're making, pencils, paper, whatever, with a byproduct of waste. So it moves from low entropy to high entropy. This is why this law is why the cup of coffee in front of you gets cold. It's why your room at your house typically goes into disorder. It's a one-way direction. If you don't add energy to the cup of coffee will remain cold. This is physics. Bear with me. I know it's hard. Let's go to the next one, the last form. The last scientific point as well is there's 5 forms of capital. This is well established. It's nothing new. Again, the order that we should think about it is from largest to smallest. The largest, which is natural capital, you might as well just think of planet Earth. That's it. Everything you see outside is planet Earth. Then you have human and social. Each one touches upon a different part of how we interact. Human is my knowledge, my personal knowledge, or your doctor's knowledge. And then social knowledge, or capital, let's say, is what institutions may know, the government. the ability of the government to govern. It could be a school's ability to teach students. That's social capital. Then the smallest is manufactured capital and financial capital. Manufactured capital is anyone look out your window, all the stuff you see, manufactured capital. Bridges, tunnels, airports, shopping centers. And then financial capital is money. Why am I telling you this? Because this leads to a key idea that differentiates the two kinds of economics. You have weak sustainability and strong sustainability. This has also been very well documented. It's been around for a long time, nothing new here. Weak sustainability, which is what neoclassical economics believes in, is an idea that all these forms of capital that I walked you through are interchangeable. It doesn't matter if I have more natural capital or social capital or built capital. You can play around with all the capital, and as long as you kind of balance it, it's fine. It's a win-win, no problem. Strong sustainability, which is ecological economics, doesn't believe in this idea. They have a different conclusion that you cannot interchange these forms of capital. Seems like a little detail, but it makes a big difference in the long run. They believe that natural capital cannot be interchanged with financial capital as if it's the same, because you can't, and you can just price it and change a tree for a pile of dollars or euros. They don't see that. They don't believe it. So their conclusions are very different. And this difference is known as weak and strong sustainability. That gets us to the next point, which is how the economics themselves work. So this is what is called the circular flow diagram. Classical, neoclassical economics, open any textbook, this is what you're going to see. This was developed maybe 150 years ago. I don't remember, but it's standard neoclassical economics. This is the way they see it is an isolated system that everything just kind of flows in and out, goes round and round, and that's it. You have Earth, natural resources that are apart, separate from. They're there, but they're on the side. And there's a relationship, but there's nothing more than, well, we're going to use resources, and then we're going to make goods and services. We're going to sell them. Households going to buy them. The money will flow, and so forth and so on. That's one view. The next slide is the ecological economics view. If you go back to the 5 capital principle where you started with the Earth, the ecological economists believe that the economy at the micro level, at the firm level is what we would say, which is the inner part, it works very similar to what a traditional economist would say. But the difference, and the big difference, is how it relates to the Earth and the environment. Because they see the economy as an open system, remember what the other guys say, it's isolated, things go into the economy and out. You have inputs of energy and matter, and you have outputs of waste. Carbon emissions, that's a waste. That's included in this model. In the neoclassical version, it's not included. What happened in the history of the development of economics was that about 100 years ago, some British economists came up with the idea of externalities because they saw the pollution. At that time, it was pollution. Today we have different things, but back then they could see the smokestacks. You can imagine some horrible place in England with slave labor and ugh. And they realized, hey, there's some stuff going on here that our models don't include. So they created something to kind of capture that idea, which was external to the system, hence externalities. And so we've been trying, myself included, for the last 25 years to internalize those externalities. All the while, ecological economists, it's like, there's no externalities. Your just model doesn't work. They're here. You just don't account for them. That juxtaposition of economics leads us to the next slide, I hope, which is an idea that was created by a gentleman by the name of Herman Daly, who there's a wonderful story about him, article in the New York Times written a couple of years ago when he passed away. And he was a traditional economist that realized that there was something missing. And he built his ideas on another gentleman who's a Romanian, Georgescu Rogan, who did some amazing work taking the laws of physics and embedding them in economics, which had never been done before. And he was a Romanian immigrant after the war, moved to the United States and was a professor at the University of Vanderbilt. And he was the mentor of Herman Daly. Herman Daly arrives to this conclusion that we are living in what we call today a full world, as opposed to an empty world. And what does that mean first? So if you look at the picture, you can see that there's the globe, that's the earth, and the economy, that's inside. 100, 200 years ago, Adam Smith's time, you can imagine, the economy was cranking along, but it was still relatively small when you looked at the planet, the size. And hence, they didn't have a lot of problems. The economy the nature has an ability through a series of cycles, carbon cycle, water cycle, et cetera, to kind of take the waste that we're producing and recycle it. So they didn't see the problem. They did see the smokestacks and things like this that caused a few economists to create this externality was quite prevalent in big cities in Europe during the Industrial Revolution and things like this. But in general, we were inside the limits of the planet. Now you fast forward, and now anyone can look out the window and you can see things are not normal and extreme. And I don't have to go through this list. I think everyone here would agree. You have extreme weather, the food, problems with the ecosystems, the Amazon, et cetera, et cetera. Why is this happening? Because the economy has grown in a size, especially since the 70s and 80s, when most of us were born, that we're bumping up against the limits of the planet to kind of reset itself or kind of deal with our waste. Remember, it's an open system. The bigger the economy, more things go in, more things go out. The more things going out are causing us to be in a full world. Now, you're going to say, well, Steve, how do you know? How can I validate this idea? You're crazy. Next slide, please. There's something called the planetary boundaries. This science was created in the early 2000s by the Stockholm Resiliency Center. They have a brilliant website led by the best climate scientists that exist. In my opinion, there's some others. They work internationally with everyone. And what they have been measuring over time is this idea that the planet has a carrying capacity. It's like a bucket, right? You can only carry so much water in a bucket. Every time you overflow, the bucket overflows, the water spills out. It's a simple idea. What this is showing you is the green is the safe operating space that the planet can operate in. The red is where we're in trouble. And if I showed you a series of from 2000 to 2015, 2020, et cetera, you would see the red is just getting bigger and bigger and bigger. And our interpretation, and as well, the whole ecological economics community and climate scientists, is it kind of shows you that we're living in a full world. It's the scientific proof, in fact, that we're living in a full world. And that at your economics, if you don't believe in that from this framework of neoclassical economics, of course the policies that you're thinking about, of course the financing structures that you're imagining are flawed fundamentally because your economics are flawed. Finance doesn't operate by itself. Finance works on a series, like I said, of economic assumptions. And it's not just interest rates and things like that. It's bigger, more complicated topics. So at this stage we're in today, either you believe in the science or you don't. I love telling people, it's like, if you don't believe this has hundreds of PhDs behind it, peer-reviewed papers, et cetera, et cetera. If you don't believe it, fine. Just please give me your cell phone, give me your Wi-Fi, please give me your Netflix account, because that's all science. So if you don't believe in that, what are we going to talk about? Let's get real. So I think with that, I will pass it off to I forgot. Oops. So where are we trying to go? That's important. This is donut economics. Kate Wayworth has done a great job of kind of conceptualizing in a simple way, but it's all basically the same ecological economics, the similar idea. To understand this, everything inside the circle, without a lot of explanation, is what we need to survive as a person. You need food, water, shelter, et cetera, et cetera. Everything outside of the circle of the donut are the planetary boundaries that are going down the toilet. You put it all together, and our ambition is to get in the safe space, the safe and just space, in the green space in the middle. Hence the donut, which she doesn't really like, the concept. I've heard she doesn't like the idea that it's called a donut because it's not very cool. But and I'll leave it at there. This again is based on ecological economics. It's all based on the same ideas, and then I'll stop it there.
So this brings us to what it would take to get into the safe and just space. For those of us living in the global north, what that would look like is a decrease in energy and material throughput during the same time that we increase well-being. So that's been defined as degrowth. One definition that we use is that degrowth is an equitable downscaling of production and consumption that increases human well-being and enhances ecological conditions at the local and global level, both in the short term and in the long term. What's important to note here is that degrowth doesn't mean recession, so it's different from the recessions that we expect in our current economic environment, because it's intentional. We're choosing to consume less. We're choosing to reduce the size of certain sectors because we understand that that has an additional value for us. So it's in a recession, it's usually the people that are already marginalized that are hit the hardest, and degrowth in an intentional way could help counteract that. Degrowth also doesn't mean that all sectors would shrink. It would look different in different industries. I'll touch on this a little bit more later. But we would expect certain sectors to grow, like arts and culture, care, renewable energy, and public transport. Degrowth also doesn't limit development in low-income countries. In fact, it may be just the opposite, because by taking less space in our carbon budget, in our material budget, the global north could make space for the global majority to develop on their terms, and also find their own sustainable and self-determined solutions. So that leads to the question and answer section for this first part. Laura, do we have any questions for Steve?
I have not seen specific questions coming into the chat. I think that there were some questions around the tipping points and sort of trying to understand where we're at exactly today in terms of tipping points. Have we reached 7 yet, or are we reaching the 7th? And I think we can just share with our audience where they can find this information, right, Steve?
Yeah, the Stockholm Resiliency Center has a website, and they're the experts. You want, those questions are quite scientific. We're not. I can't say I'm super comfortable saying, yeah, we're close or not close, but I think that's been the focus of their work, and that's what they're aiming to do. And I've noticed that the main director, which I always forget his name, I can't remember his name.
Johan
Johan Rockstrom.
Thank you. He has been talking a lot more on the topic. So he's getting, I mean, obviously people are interested because they're saying, so, that's really for them. We can't do everything. I trust the scientists and the science, right? I'm just interpreting it as much as I can as a finance professional and saying, oh, okay, what does that mean for the economics? And then as a result, what does that mean for finance?
I have a couple of more really interesting questions, and then I actually have one of my own that came up, but let me start with the audience's questions first. One really interesting question sort of reflects on the moment that we're living through today, and I think that they're thinking about some of the sort of economic turmoil caused by policies. And the question is, can this recession, obviously, I think they're referring to trade wars, et cetera, that will most likely lead to a recession, get converted into a degrowth trigger? And I think that's an interesting question. So I don't know if you want to take it, Steve.
Well, I'll jump in and start if you want, and Steve can come. The difference between, that Steve talked about, and this is something in my degrowth, post-growth journey, when I first came across the word degrowth, I thought it was a terrible word and a terrible idea, because what I took it to mean was, let's have a Great Depression on purpose to right size things. And of course, once I dug into things more and researched more and found out more, I realized that's not the case. A recession or depression in our current economic thinking is not intentional. It's kind of an accident of the markets operating, and it happens every once in a while. Isn't that a bad thing? And then we correct it, and things are fine again. The difference is, of course, that as Steve and Anastasia said, that a degrowth path to a post-growth world within the safe space and the donut, if you will, is intentional. We're going on a diet, if you will, and the metaphor that Steve used of keeping the water in the bucket, because if you look at the planetary boundaries, we're beyond 6 of them, and a 7th's on the way. The 7th one, I'm gonna see if I can remember them all now. This is probably a bad idea if I miss them all, but the 6 we breached are climate change, biodiversity loss, land use, water use, novel entities, which is mostly plastics, things that in the environment that shouldn't be there. And biochemical flows is the last one, and that's usually nitrogen or phosphorus making its way into our waterways and soil, and that shouldn't be there and causing bad effects, like causing dead zones in the oceans, for example. The 7th one that we're likely to breach in the next decade or two is ocean acidification. And that's our biggest carbon sink in the world is the oceans. It's 2/3 of the planet, and they suck in most of the carbon dioxide. The problem is that's turning the ocean acidic. You and I have a pH. We learned in chemistry class, you and I have a pH. The oceans has a pH. It can be basic or acidic. Well, all the life in the ocean is used to, what it is now, what the ocean is now. But as it becomes acidic, less and less things with small shells that are being part of the food web can survive. So the concern is that could cause a major die-off in the oceans, and that's the 7th planetary boundary. But the difference is that the answer to the question is no. A recession or depression, if we have one, and that currently or in the next couple of years, isn't intentional. And the thought processes of everyone is, let's get out of this thing. Let's do whatever we can to get back to the growth model that we had before. So it's not, I don't see it really being a trigger for getting to a degrowth world. It may make people consider a post-growth world, but it's not itself a trigger to get to one.
Yeah. There's a really interesting question next that I think we should take now, which is, they're saying, I think this is Katie, they're saying, I don't disagree with the analysis. However, incentives throughout the financial system, not least pensions, are structured in favor of continuing growth. What are the practical steps that financial sector actors could take towards integrating post-growth considerations? Or does this start and end with policy change?
Yeah, so that might be a perfect transition to my section. Maybe I should just move to that now, if that works.
And I think,
well, wait a second. Do we have any other questions?
Yeah,
there's
another interesting one. I think it's connected. This is Charles, and he says, I'm fascinated by the fact that several of you founders of the Institute are from the capital market sector, from finance. As someone observing outside that sector, it seems to me that financial capital defines its role and culture around measuring all important matters by return to money invested. Nothing such as externalities or of environmental costs or human costs matters to the bottom line. And I think that's also something that would be a really good transition to your section, Anastasia. And then there's a question about the politics of this, which I think I'll leave for the last part for you, Matt, for now. So I think we're setting up a couple of really good questions for you, Anastasia.
Great.
Yeah,
Anastasia,
great.
if you want to go ahead.
Yeah. Also, maybe if we, or just one point to touch on with regard to, oh, you're all coming from the finance sector and the incentive structures are really not aligned with degrowth. Indeed, that's exactly why our initiative exists. Basically, we want to make it easier for other people to be exposed to these ideas and begin collaborating on newer solutions, some of which I'll highlight in this next section. Basically, we see it as part of a just transition. When we talk about a just transition, a lot of people just think of coal miners and things like that. But it also might mean wealth managers. It also might mean hedge fund managers. It also might mean other people whose roles are going to change as we try to bring our economy within planetary boundaries. So in my section, I will talk a little bit about what that might look like for us in finance. So as Steve's section introduced, it's pretty clear that business as usual is not a sound investment, and we should be looking towards transitioning towards something better. But what would degrowth mean for finance, and what should financial professionals be prepared for? If we look at this graph of kind of a summary of a growth economy to a degrowth economy and post-growth economy, just intuitively, I think it makes sense that the tools and instruments that we were using for this growth part of the diagram are going to be different than the tools and instruments that we need for the degrowth part and the post-growth part. When we make this more concrete, what we're talking about or what we expect is that the degrowth will require pretty significant definancialization. So over the last several decades, we've seen kind of a ballooning of our industry. Finance has grown to an extent that it's currently estimated to be between 20 and 25% of the global economy, which is extremely high. That's almost a quarter. That's quite a lot. And as finance has been growing and establishing itself, it has brought with it this emphasis on short-term returns as being more valuable than long-term value, which has had wide sweeping effects far beyond the industry. So influencing what's possible for business and influencing our cultural life as well, our society more broadly. And importantly, for the topic we're here to discuss, it has constrained sustainability efforts because of this kind of return on investment mindset. Thinking about what would need to change in the real economy, we won't get into that in too much detail. There's many scholars who are focusing on that. The real economy part of this chart would change as well, but it's really that section of the pie that currently represents finance. We would expect that to become smaller in a degrowth transition. It's clear that many in our industry know that things need to change. Sustainable finance as we know it today, basically we see it as an incomplete solution. This isn't a complete list of strategies that are applied in sustainable investing currently, but that's some of them. And without getting too much into it, basically all of them still are built on the assumptions of neoclassical economics. Therefore, they don't account for energy and matter, and they aren't looking at things like planetary boundaries from the get-go. So in many ways, even though some of these are well-intentioned, it's not really serving the purpose of getting us into that safe and just space of the donut that Steve described. It's also increasingly obvious, both to external observers as well as academics and practitioners, that the difference between so-called sustainable finance and traditional investing is really fairly negligible. The focus is still on financial returns, as someone in the chat brought up, and that leads to very minimal additionality, which is basically the difference that you make as an investor when you choose to invest in something or choose to invest in something else. CSP, where I'm affiliated, also has done some research on this, but the current outcome is that basically sustainable finance as we know it today is not enough to address the challenges that we're currently facing. So what does greenwashing mean in this context? Greenwashing is a big topic within sustainable finance for good reason. In the paper, however, we outline two ways to think about greenwashing. One is what I would call traditional greenwashing. This is when firms are being intentionally misleading. So that could be someone marketing an ESG fund as contributing to climate action when in fact it's pretty debatable whether that's actually true or not. That would be type 1. Type 2 is unintentional greenwashing. So this is when we're really trying our best, but we're just using this toolkit that's based on neoclassical economics and therefore uses outdated assumptions and isn't really in line with bringing us into the donut as described before. So these two types cover the majority of the industry, I would say, with some exceptions, some of which we mention in the paper. And yeah, might get into a little bit later. But we thought this was a helpful way to think about it. So in light of all of this, it's clear that finance could benefit from a different sense of purpose, from a renewed vision. And in the paper, we are fairly bold in our call for a more holistic understanding of value. And we propose that a new purpose for our industry could be based around the idea of wealth as well-being within planetary boundaries. What does this mean in practice? It's a very good question. One bank that has been leading the way is Triodos, based out of the Netherlands. This is from their 2004 long-term outlook. The graph shows the industries that they expect to grow and the industries that they would expect to become smaller in the course of a degrowth transition. So you see care and arts and culture would be expected to become larger, while mining, energy production, and finance would be expected to be smaller. And when we look at those bars for finance, this in many ways reflects the definancialization that we mentioned before. So in order to provide some guidance for those of us that are interested in finding a better way and bringing our financial toolkit, like building a financial toolkit that acknowledges planetary boundaries and works to create that safe and just economy, we drafted, I would say, 5 principles in our report. This builds on work from Florian Barras, who's here in the call, and also work that I did with Jennifer Wilkins last year. So we're going to continue to iterate on them, and I'll be interested to hear your feedback, what you think is missing, how we can improve them, because it's really a working document. The first one is that new purpose that I talked about, a shared foundational goal for our industry as wealth as well-being within planetary boundaries. We already see some impact investors and foundations thinking about value in different ways. So maybe you've heard of multi-capital or poly-capital approaches that kind of tap into that 5 capitals idea that Steve explained. But basically, this point is about redefining what's worth having in the future and reorienting our economies and our portfolios around that. So we might not just want to have financial capital in the future, we might want to have a functioning ecosystem, societies that are thriving, etc. The second point is investing in real economy degrowth. So Triodos also has a helpful model for thinking about this. They refer to a differentiation between investment in the real economy and investing that's basically just money making more money. Which is, yeah, something that we also do in our industry. So investment in the real economy has a purpose and a goal. It can support, like we can use it as a tool to build the infrastructure, provisioning systems, and kinds of organizations that we would need to realize a post-growth future which provides for everyone's needs within the boundaries of the planet. So that's investment, and that's what this second principle is about. The third point is about becoming more transparent. Here, a big topic that we touch on in the paper is the topic of ESG ratings. So these days, ESG ratings are proprietary and remarkably inconsistent. You can check the Aggregate Confusion project at MIT Sloan for more information on that. So this is kind of twofold. We need to be more transparent within our industry about what we're doing, what we think is working and what not. But also we need to be more honest about what it's possible for sustainable funds to do and not do. So we need to offer a more realistic picture of what's possible using sustainable investing. Here, the key takeaway is that collective improvement, we need to see that as more important for our industry than individual company profit or the survival of outdated business models, because the goal is not that one bank survives in the rubble, but rather that we increase the odds of successfully bringing the economy into planetary boundaries, the safe operating environment that we need to live, which is in everyone's best interest. The fourth point is also has two parts. So be more democratic. This has to do on one side with investing in and supporting more democratic forms of business. So alternative ownership enterprises, Transform Finance has been doing a lot of work about that. Traditionally, organizations like co-ops or other alternative ownership enterprises had trouble getting access to capital because they were perceived as more risky. But if we have this changed mindset where we understand that communities understand their needs and are likely to be more resilient, it provides a different backdrop for investing in them. On the other hand, we see an interesting opportunity for finance to actually become, so for financial institutions to become platforms for democratic engagement, because basically investing is one of the key ways that we make decisions about what should exist in the future. Today, we do that based on relatively short-term interests and these incentive structures that don't really lead to a thriving future. But if we want to do that, we might need more voices in the conversation, and it might not just be financial analysts that are making those decisions, but rather communities. And so a renewed sense of meaning could come to our industry by providing platforms for democratic discussion. We already see some examples of that in the economy today. So you see, for instance, participatory budgeting emerging as a practice for making collective decisions about what a community should invest in. And we also see citizens' assemblies as another way that we can get input from the communities we're serving. Finally, the fifth point is that we would expect to see organizations in our industry focusing less on being too big to fail and focusing more on being small and varied enough to be resilient. So even though we expect the finance industry to decrease in size relative to the real economy in a degrowth transition, we would actually expect the actors within that system to potentially be more varied, more diverse, more resilient, and more distributed than we see today. As an example, we have, say, public banks, community development financial institutions, ethical banks, bioregional finance facilities, some other examples that we mention in the paper. And basically, we see that there could be many opportunities for professionals in our sector that want to continue working in finance to contribute to those sorts of organizations and be a part of a more varied, dynamic, and resilient post-growth financial sector. And we hope that those of you that are listening might be interested in contributing to that as well.
All right, so there's been some really good questions pouring in. So Since we're still in the finance section here, I think there's a couple that perhaps you can help address, Anastasia. The first is around how do you talk about the return profile of an investment, for example, in decarbonization? It is very easy to understand how an investment in oil and gas, for example, like what's the return profile, what are the cash flows, etc. How can you have the same story about investments in this kind of economy that we want? That was one of the questions here.
Yeah, yeah, sure. I mean, I think part of the answer of this is that we're actually not telling the same story. So I think one of the traps that we have fallen into collectively is looking to basically play the same game as before and just try to convince people using the numbers, using other forms of return, calculating how much value a forest provides us, doing that kind of thing in order to try to make those arguments. And I think what we're trying to do is take a slightly different approach, which basically gets you out of the game of trying to just quantify everything and having that mindset of like, what's the ROI? What's the ROI? What's the ROI? But rather saying, okay, if we want to have a more livable future, how can we kind of work back from there? And that's going to ultimately be more valuable than individual financial returns for any given investment. That being said, we recognize that it's a really big mindset shift, and we're interested in having conversations and developing tools that can make that more palatable for people. But I would say that we're not going to try to play the same game as before, and make the same arguments in the same way.
There's
Yeah,
another.
and just
Oh,
I was
sorry.
just
Go
going to
ahead.
say, no, I was just going to say, just to interject, that gets a lot to what I'll be talking about is that we're telling a new story, and people need to understand how to tell the new story. And we say in the paper that, for the last 50 years or so, the decision rule has been ROI, has been what is the return? And the decision rule really needs to start with, does this get us within planetary boundaries? Is this within the guardrails to keep us within the donut or planetary boundaries? Our survival needs to be the decision rule, not what's the return on investment. So, but I'll get into more of that later, but I'll stop there for now.
Think of it this way. Every time that you have a deal or a loan, an equity investment, it doesn't matter. You've looked at it at a very micro, like project level, company level. And if you go back to what I was talking about, how ecological economics versus neoclassical economics, the neoclassical economics is just the firm level. That's it. That's the only consideration. There's no other. It's just not enough anymore. So you have to expand that. We don't have that. We don't have it yet. We don't have that kind of, but you got to remember that the accounting that any one of us learned is 300 years old. And if I remember correctly, the great story, it's two Italian monks that had to account for the wine they were making. And it's that old, the accounting system. So that accounting system doesn't work anymore. Now, I know there's endless and a lot of work that's been done, but none of it has been enough. And none of it has been enough because it's based fundamentally on the neoclassical economics. And so it's stuck. How do we do that? We don't have an answer today. But imagine a system where the deal can be looked at in this broader context of nature, of the planet, of the region. There's some great work being done by, I can't remember the name, but it's been co-funded by and co-ran out of one of the UN institutions. I can't remember the name.
R3.0.
R3.0 plus some people at the UN, and they developed a system. And it is the best set of kind of accounting, if you will, to do exactly what you're proposing to do. It looks at the deal in the context of the region, the region, and I mean the physical space. That's it. Thank you, James. That's the one. He puts it it's in the chat. This is an amazing thing that they did. Is it perfect? No. But is it better than every financial model on planet Earth? Absolutely yes. Why? Because it does what we're talking about here. So if you haven't seen that before, you should check that out. And so there's a lot of stuff going on. And that's the only thing that should give you some hope. We've got a lot of the tools. We're not 20,000 miles away, but it's a huge mindset shift. There's no doubt about it.
There is an interesting question for those of us who have worked on bond markets about the fact that paying back a loan or any debt obligation sort of inherently requires growth. And so how do we move the system sort of in a wholesale way away from that kind of structure? Anyone wants to take that? I mean, part of it is what we just talked about, but I think that's an interesting question.
Yeah, I'll start and people can jump in. But yeah, look, this isn't, and I'm going to get into this more in a little bit, is that this isn't a snap your fingers thing that's going to change. This isn't going to happen tomorrow. This is a change in culture, a change in policy, a change in finance, a change the way I see our world and we see ourselves and our own stories we tell ourselves. And that's going to take time to change. And the impetus for all this is the planetary boundary framework. We see we're living in a full world. If we had 200 more years to solve this problem, no problem. We'd figure it out slowly but surely. But that's not the case. There's the house is on fire kind of emergency here. And so we don't have an option to not make these changes. So with that as an impetus, why we started Arketa, excuse me, and why we're doing this is that we understand we need to change that conversation and normalize these conversations. Matt, Anastasia, and Steve aren't going to come up with all the answers, maybe some of them, but we need to have this conversation so the industry itself can come up with these answers. And we've been investing in head markets for thousands of years. It's just, and I'll get into this a little bit more, it's only in the past 100 years or so that we've really supercharged growth as the reason our organizing principle about the way we live our lives and the way we run our economies and the way we have run our culture. And so we've had ways of getting investment before. Some of it is equity, some of it is bonds. The nature of those will change in some cases. There's models out there. There's that a lot of academic work is already worked on, and a lot of examples in the real world about how this can work. Some banks we mentioned in the paper who are kind of that Florian calls them ethical banks. They put things like impact on the bioregion into the discount rate. They put it into the bond coupon and things like that. There's a lot of different ways to look at it. So the answer is this is we're just beginning on this journey, and a lot of it's incomplete, but things will definitely need to change in both the equity and bond markets and how we do that.
And another thing I would say to that is that we just need you just need to imagine something different, and it's hard. It's just hard. If you're in London or you're in New York, you're like, oh, but it only works like this. I can imagine. I see a friend of mine here who worked for a big investment bank in New York. Yeah, I can imagine him going, how are you going to change it? But 100 years ago, 150 years ago, it was very different. We lived in banking was very simple. The financial sector was very simple. It only did simple things. It's only, again, from the 70s, and it's not random that when we went over the planetary boundaries before they created the planetary boundaries is in the 70s, which was documented in the book The Limits to Growth. It's when neoliberalism took over the planet, led by the Americans and the British, and then everyone else, right? So before then, it wasn't so crazy. Why can't we just go back to that? Let's just do that. I'm not asking you to go outside and be a rebel and throw rocks and throw Molotov cocktails. Let's just go back 100 years and live a bit and calm down a bit. That's it. Do we need, hedge funds doing what they do? No, absolutely not. Now, but you're going to get into a lot of people that have vested interests, and that gets tricky. Hence the need to organize. Hence the need to get people that are in the same framework together. And that's part of this thing here I'm convinced that there's a lot of finance people out there that are going, this stuff doesn't work. I talked to a friend of mine, ex-Goldman Sachs, very smart guy. And he's like, I don't know why this doesn't work. So I just gave him the 5-minute version of what you guys are hearing. He's like, yeah. Okay. So there's plenty of people out there. The question is, how do you gather them together, I think, into something that we can use? as a political force, because everything at the end, the economy is driven by the politics. As a student of political economics, so that's my 2 cents.
I agree and sympathize so much with that view as somebody who has also spent a decade in finance, working closely with capital markets. And honestly, like I thought at the time really trying to change things, but there's a lot of inertia in these systems.
No.
But there's also enough people that see the limitations and see the problems. It's just
and they want to do good, and they want to make it. Yeah, and let's go talk to them.
Exactly.
Let's get them together.
It is a failure of the imagination, right? And so people like David Graeber, I think, have written really eloquently about that and sort of challenging what we think is established as a norm. But no, there's been people have done things in many different ways, throughout our history. It's just a matter of like being imaginative. So, anyways,
and knowing history. You got to know history, and that's the history. History is so important. Because if you don't know history, you don't know where you come from. You don't know where you're going. And we've kind of, especially in the United States, history is not the most popular subject. No, people don't read too much. But if you read it, I don't think people were living so bad 100 years ago that was like, oh yeah, let's not do that. Yeah, why? My cell phone? That's not so great. My cell phone and instant this and instant that. It's not really working. You just got to admit it first.
There's a couple questions around opportunities for collaboration between the financial sector and other parts of our society. And I think we kind of addressed some of those, but it'd be great, maybe Matt, to hear from you a little bit later on this. I just want to go through like a sort of a list of topics that I see are recurring. There's questions around what about different players in the financial system? One thing is a bank that has some agency around, who they give credit to and who they don't. But one thing is a pension fund that needs to think about their obligations to their plan participants today and then in 50 years. There's a lot of fiduciary responsibilities. And so how do we think about that? There's questions about, have there been any countries or political leaders that have embraced these views?
Uruguay.
What's that?
Uruguay. Uruguay today is kind of like the first example where they have a zero kind of footprint, from what I understand. It's probably not perfect, but it's pretty. All their energy is renewable, so that right there makes it a lot easier. And then this point about the different institutions is very fundamental. Intermediaries are probably not going to be the people that are going to want to change because they're just deal makers, having been one myself, right? Pension funds, whoa, there's a different story. And insurance, whoa, that's another one of my favorite. Those are my targets. Those two groups, because they backstop every decision with the insurance, right? And then pensions, because they're huge and they fundamentally have a different priority. They're not selling you products or deals. They're ensuring that you have a pension. Where Goldman Sachs trading desk is not thinking that. They're just thinking, how do I extract maximum today before the whole system crumbles? Because they know it. A lot of people know it. So they're different and different strategies to get to those people, different talking points. And we'll be getting into that as we move forward. Is how to strategizing, but we need help. Let's be honest. We need a lot of help to get to these kind of people because they have power. And how do you get them together and things like this?
In fact, that's one of the projects we want to do. Our next big paper, if you will, is tackle the pension fund question, because that's the first big question you get is, okay, I have a mortgage I have to pay. I have a 401k or a pension. I have kids college to save for, my retirement to save for. That all gets into savings and pensions. You're asking us to blow up the system that provides all of that. No, thank you, is the polite response we get. And so we want to tackle that with our next report that will probably start over the summer and the fall, probably come out late this year, early next year, to really get into those questions in more detail.
I have a question here that I think is an interesting question. You haven't mentioned human population growth. Why not? What's your stance? That's an interesting question if you want to take it. And then I think maybe we have room for one or two, and then we move on to the next section.
I'll start with the Malthus question because that's where that's coming from. Thomas Malthus, one of my favorite economists. Not really, but just because he was one of the first started talking about population, and this was back, hundreds of years ago when we would have population booms and bust, and it was mainly around resources. A population got so big and then it used all its resources, or there was a famine and things collapsed. And so there was, part of this conversation is always, well, resources, you need less resources if you have less people. Are you talking about, population control, those kind of things? And if you look through the degrowth, post-growth literature, that's not really part of the conversation. That's not where really this goes. But I'll address it, because that's not. Yes, if we had less people, we'd use less resources, but it's mainly about using less resources and having less waste. An example we give in the paper is if you look at the carbon emissions of per capita around the world, a family of 14 in India has a lower carbon budget or a lower carbon footprint than a family of 2 in America. So it's not that there's more people in India. There's a lot more people in India than America, but we're more of the problem in America. I'm an American because of the use of resources. So it's really, the math is that it's just the global north really that needs to cut back and go on that diet, because those buckets have been overflowing for quite a while. And the population of those areas is actually less. So it's resource use and it's lifestyle and it's the way our cultures and our economies work. It's not really, yes, population is part of it, but that's not really where the heavy lifting and the solutions is going to come from. Steve, you're on mute.
To add to that point, which is a good point, it's an excuse. It's just frankly an excuse for people not in the North, right? You have to be honest. We're not going anywhere if you're not honest. It's us, Americans, the French, we're the problem. It's not people in sub-Saharan Africa. So let's quit. This is just baloney. It's us. And it's just a way to just deflect. Oh, no, I still want to have my Range Rover, my EasyJet flights and eat. And no, we've every time you look around, think that everything you see around you is what is causing all these problems. It's not someone else. It's you and me. Let's be responsible and change. How do we do that? Of course, it's complicated and all that, but that's the basics. We need to go on a diet. We, me, you, everyone on this call. As not fun as that sounds, because diets suck. But once you get through it, once you lose that weight, you're feeling pretty good. You're like, well, this is not so bad. That's degrowth. It's that simple. Of course, there's some details. There's some details in there. I must admit, I'm skipping over a few details, like the revolution when the hedge fund manager is throwing Molotov cocktails at me. But there's enough people that's why all this is moving faster than we think, because the climate is driving people that you just can't hide anymore. Before you're like, oh yes, no big deal. No. LA fires, et cetera. This is just going to happen more and more and more. So what I always tell people, what used to sound as insanely radical, all depends where you sit in history, right? What was crazy 10 years ago is like, yeah, sure, let's do that. We need to do that today, just because things have changed and the kind of your frame of mind changes. And I think we're living that change. Another thing I just got to add this to this point here is I was on a podcast, listening to a podcast from a guy who runs the Carbon Tracker. And I'm not going to tell the whole thing, but he was saying that the oil and gas sector is just basically shrinking itself. And he said they're passing, instead of investing in new projects, they're returning capital to investors through dividends or buybacks or whatever. They're just kind of getting out of the business of being oil and gas. This has blew my mind. This guy's name is Mark Campanelli. I've known him for a long time, very smart guy. And he was saying this on a podcast. And the implication is that they themselves, people that don't believe in any of the things we're saying today, realize that the game is up. So imagine that they're de-investing themselves because they're like, yeah, we can't do this anymore. So it's happening all over in bits and bobs, but none of us are, we're not AI, so we can't look at everything at the same time, but it's happening faster than you think.
Love that. And by making all these comments, you actually answered a couple other questions, which is great, around the urgency, like how can we communicate the urgency of this moment? And also, are there examples in specific sectors that can be adopted to other sectors? Can we start micro to build this at a more economy-wide level? And I think I love Mark Campanale. I've known him a long time too. Fantastic work. And I think the example of the oil, I talk about that all the time because I think it's just really telling. So
Did you hear
I
that?
think
Did you heard that you heard that podcast? Okay,
I
great.
didn't hear the podcast, but I talk about this a lot in other contexts that we'll discuss. But basically, anytime you as a company buy back your shares, it's an admission that you don't have a good investment plan and you give this money to your shareholders who
Right.
can invest it in something else. And so
Right.
what is more defeatist than that, right? It is financial engineering, but it's also an admission that you're not going to be able to use that capital in an efficient way.
It's good news.
Yeah.
So that if they themselves are, it's kind of doing that. For me, it was like, wow, unbelievable. It was the first time I've heard this, and I've known Mark too for a long time. I almost like wanted to email him directly and go, Mark, can you explain this to me? I'm dying to hear this.
I use this example in my class, and people really don't think about it in these terms, but it's just really interesting framing. All right, and so with that, talking about framing and talking about narrative, Matt, we're finally going to hear from you. How do we do this? How do we tell this story?
All right. I sneakily gave the long, laborious parts of the presentation to Anastasia and Steve, so I apologize to them. No, that's just kind of the way it turned out. But I'll be short and sweet so we can get to some of the questions, some more of the questions. We have it in the paper, but we don't have it in this presentation. But thanks to Gus Schillick, and Gus, I may be butchering your last name, but Gus for putting in the Buckminster Fuller quote, "You never change things by fighting the existing reality. To change something, you build a new model and making the existing model obsolete." So that's kind of what we're looking to do. But we're starting from, a very small base. We think we're the only post-growth financial think tank in the world. I'm pretty sure we are. And there's hundreds of ones on the other side of that conversation. But we feel this conversation needs to start because that revolution in thinking, that revolution in imagination, to imagine a new future, needs to start. And before I get into this picture and talk what I'm talking about, there's a great picture from, and I forget the exact year, but it's about a little over 100 years ago, of New York City taken from, high above New York City. And there's one car in the picture, and there's about 24 carriages drawn by horses. And about 10 years later, that picture is exactly the opposite. It's all cars with one horse, all horseless carriages and one carriage pulled by a horse in 10 years. That's one of the biggest changes we've seen in the past couple hundred years. And it happened really quickly because the culture changed, because necessity changed. So we see that these things can change. And we want to help people normalize this conversation so people in finance and other industries see that, there's other crazy people out there like me who see what's going on and want to have these conversations and build from the bottom up these communities that puts pressure on decision makers and policymakers where the decisions will need to come from. So I'll just set up with that, but then I'll get into what we talk about in the paper and changing that story. So look at this picture. What thing in this picture grows forever? It's a trick question, of course. Nothing in this picture grows forever, but we live in an economy and a culture that assumes our economy will grow forever. And that's a bit ridiculous when you think about it. The trees in this, the trees in this picture, we've all heard the phrase "no tree grows to the sky." We looked it up, and that actually comes from a German saying from the 16th century. I will not try to pronounce it in German. Anastasia knows a little German. Maybe she can take a crack at it. But no tree grows to the sky. We all hear that growing up. I think about the gentleman in this picture and yourselves. We all stop growing about 18 to 20 or so, unless we have a thyroid condition or something that's not working right. We all stop growing. So why should we expect our economy to do the same, to do anything different? take a lesson from, the trees and ourselves and any biological, animal or plant. We all reach a certain height, we're mature, and then it's maintaining what we have the rest of our lives. And our economy, we should treat no different. Next slide, please. And the humble snail. We often see the snail as the symbol of degrowth, and people think that's because the snail is slow and we want to slow down. That's part of it. But there's also the part of it, you look at the snail shell. You can see those ridges on the shell. Each of those is a new section of the shell that the snail, he or she, has built. And when he gets to maturity, I'm going to just assume this snail is a he for the sake of this example. When he reaches maturity, he's done. What would happen if he built a new piece of his shell? His shell, it would collapse on top of him. He'd be overwhelmed. So he's reached his balance. He's reached the end of his growth cycle, and now he's maintaining the rest of his life. If he added to it, it would be self-destructive, and that's where we are. So that's another reason that people don't really realize that the snail is one of the symbols of the degrowth movement. Next. This is something we came across in our research, and it's from an author, James Clear, who talks about behavioral change. And you look at kind of three levels of behavioral change. One is the outcomes on the outside. That's the things we want. Say, like, we want green funds to invest in. Then inside that is the processes. Process in that example would be we do research on green funds. We do research on companies. And the identity is how we see ourselves, and those two outside circles inform that. Because of the outcomes we want and the processes we go through, we see ourselves as a green investor or a sustainable investor. But this can apply to anything. And it applies to how we see the world around us, whether that's our investments or the culture we're in or the political party we're in. We see ourselves and how we identify ourselves by the world around us, by capitalism, if we're most people on this call. And so if we, as our Arketa Institute, threaten that or question that, we see that that's going to threaten the identity of people in some cases. Because we've internalized this growth for growth's sake culture, this capitalist culture. And we don't want to see that there's problems with that, because that would be admitting there's a problem with ourselves, our identity. And so we need to acknowledge that and tell new stories and better stories, get to new outcomes we want. What processes do we use to get to those outcomes? So our identity that we tell ourselves, the story we tell ourselves, is about the identity in a post-growth world and not one chasing growth for growth's sake. Next. And as I said in the paper, and Steve alluded to, saying that we only really started crossing planetary boundaries about 50 years ago. If you look into the research, it was about 1970 where we started going past the Earth's ability to regenerate and pushing past those planetary boundaries. So it's only been about 50 years. You don't need to go back to 8-track cassette tapes or bell bottoms, but that was the last time that we were really living within our means as a planet. But it started much earlier than that. It partially started with the advent of marketing. Think about, if you can look up, old advertising from, the 19th century. It's very quaint. It's just, this milk is what you need. This hammer is what you need to fix your fence. There not much more imaginative than that. But this quote from Paul Mazur, an executive at Lehman Brothers, back in 1927, is very informative. We must shift America from a needs to a desires culture. People must be trained to desire, to want new things even before the old one is consumed. We must shape the mentality of America. Men's desires must overshadow his needs. So for nearly 100 years, and this is the beginning of it, we've been taught that our wants are really our needs, and that anything we want, we can have, and there's no cost for that to the environment. Go back to our talking about neoclassical economics. There's no cost for that. It's just firms providing products and workers providing work and getting wages, and that's a virtuous circle. But we're ignoring what goes into that resource-wise and waste that comes out of it at our own peril. Next slide, please. And it was about 10 years after that, in the mid 1930s, that a man named Simon Kuznets was he was an economist in Washington, and he was tasked with creating a better measurement of how to gauge how we're doing in our economy. And he came up with GDP, gross domestic product. And it's just the total monetary value of all goods and services produced within an economy's borders. But that's the way we measure our success now. I remember as a kid watching the nightly news with my parents, and I learned very early that once a month we get a report card as a country on how we're doing, and it's GDP. And if it went up, people were happy, and if it went down, that was bad. And since the creation of GDP in the mid 1930s, and Kuznets warned not to use this as a measure of how a company's doing or a measure of well-being, but that's exactly what it's been used for. Politicians, get rehired for promising growth. CEOs get, keep their jobs and get raises for growing. And because we live in a fertile world, because we're past planetary boundaries, we can't operate that way anymore. We're destroying our life support system just to grow. We're that snail. We're mature, but we're adding more shell just because that's what our culture tells us to do. That's what our policy tells us to do. And so that's what we need to change. Next slide, please. And I didn't come up with this. I don't remember where I heard it, but I'm a fan of the phrase, we are the stories we tell ourselves. Think back to that slide a couple slides ago. We identify in this capitalist economy as people who want growth. Our economies need to grow because if we don't grow, that's bad. But getting back to that Buckminster Fuller quote, we need to change our stories. We need to change the stories we tell ourselves about well-being within an economy and within living within planetary limits, or we're cooked. The Limits to Growth paper that I think Steve mentioned came out the year I was born, over 50 years ago. And it was the first time scientists sat down, MIT scientists sat down, went through their computers. Imagine what the computers doing this work were back then, over 50 years ago. And what they found was that we were on the road to ruin. And that around this time in the 20s and 30s to 2020s, 2030s, we would see a potential collapse of our societies and our civilization because of overconsumption, because of pollution, because of resource use. And that got a lot of attention at the time, but people eventually kind of forgot about it. And then a couple of years ago, researcher Guy Harrington, when she was at KPMG, she's now at Schneider Electric, revisited those things with modern computing and saw, okay, what's the story now, 50 years later? And she found we're mostly on the same path. That if we continue down this road, we are that snail building its shell that we don't need, because our culture and our policy tell us we need to. We need to change that story. Arketa Institute, we hope, is part of changing that story. And we invite people on this call to help us change that story, and to tell us people you think we need to talk to grow this community from the bottom up, to tell that story better. So I'll stop there. And we have about 10 minutes, I think, for more questions.
Thank you so much, Matt. That was fantastic. I think there was an interesting question. It was actually a question that I had earlier, that I think it's a good one to address around, okay, we've heard all about the planetary boundaries and the limits to growth and what sounds a little bit like a Malthusian, right, argument. But what about technological innovation? That's what makes humans special. Can't we solve this with technological innovation? Can you address that?
No, is the answer. We have a chapter in the paper on green growth. Green growth is not, I think the title of it is Green Growth is not the by itself is not the answer. Yes, let's green as much as we can. Green technology is green energy is cleaner than dirty energy, but it's usually just added on top of what's already there. We're still about 80% of the energy in the world is created by fossil fuels still today, and that is going down slowly by about a percentage point or two every year, which isn't fast enough. And in our research, what we found is, and we've come across this before, and this won't be new a new concept to many people on this call, but Jevons paradox. And economists were throwing out a bunch of old dead economist names on this webinar, but Jevons was around the time coal was really taking off in England, and I think it was around the steam engine was invented, and he saw that so much more work could be done for less coal going into the engine. But what he found was when we make things more efficient, whether it's the steam engine or a car, when we make it more efficient, we use it so much more that the rebound effect, wipes out any of the benefits we get from using it more efficiently. So we need to guard against the Jevons paradox and think about swapping out fossil fuels for clean energy. The amount of mining that would need to be done for the metals and rare earth metals just shifts the problem from destruction of the atmosphere to destruction of land. Think about the planetary boundaries. You're going to have land and water and biodiversity all suffering so we can bring down the climate planetary boundary a little. And that's just shifting the problem to something else that doesn't solve the problem. So yes, a little bit, but technology can't solve the problem by itself. We need to change the story to, I'd love techno future science fiction myself, but we're not going to live in one. We need to slow down. We need to go on that diet. We need to reimagine the way we want to live. And it's more about, in the end, well-being and community rather than dragons sitting on piles of gold. That's kind of the model we have now, is we all are incentivized to become dragons sitting on big piles of gold, which is nice, but it's not sustainable. And as human beings, it's not what we crave anyway. So let's not do that.
And another interesting example is with the explosion of AI models and the amount of electricity that is required to power those models, that basically it's blowing through. Electricity consumption in the US, for example, had been kind of stagnant at the same level for the last decade, 15 years. And now the growth in AI, in demand for AI services is really what's driving growth. And so, for those of us who have worked on decarbonizing the power system, we now have to have the conversations around, oh no, we need to actually turn on the old coal power plants or build more gas power plants because we can't support this with the growth of clean energy. So that's a very good example in my mind that sort of highlights how techno-optimism is great in theory, but in practice just doesn't really work. There's a good question from a student who's interested in these topics, and he or she, sorry, I lost the question, was interested in understanding what kind of skills should they develop so that they contribute meaningfully to this space and to these ideas. Any thoughts here?
Having just taught a few classes and given a seminar on this, it's like I don't know if it's a man, woman, or they're the future. So, you don't want to learn stuff that's not going to work, right? So learn this kind of stuff, or this kind of economics, and then and then talk to your friends about it. What I think the young people need is a bit of hope. Well, hope that because you talk to them, and today I gave my final exam. I was talking to you guys before this, and I asked one student in particular, was quite bright guy, you could tell, and I asked him, do you agree with what I was saying? Because I was saying this, what we presented, and he goes, yeah, there's no other way. And so, but they need hope. They need some hope, something to believe in, something to see as it doesn't sound very fun, but it doesn't have to be. As Matt pointed out, you could live in a nice way, have time off, why do you have to be working 25 hours? It just doesn't make any sense. Just to what? To buy another 2 iPhones, the latest iPhone. If you really think about what we do, our lives, it's ridiculous. It is ridiculous. And it's blowing through the planet. So why would you want to do that? So maybe that answers the question.
I would say anybody out there, student or otherwise, reach out to us if you want to
Yeah.
continue this conversation. And Steve touched on something. We go through in the paper a lot of degrowth policies and how they work, and they're already out there in the wild in a lot of places. We just didn't have time for it today. So, go through the paper, and please reach out to us if you want to argue with us, tell us we're crazy, or talk to us to help build this community.
Maybe one additional point. First off, super excited for more people to be interested in researching and collaborating with us on this topic. It's possible that next year or already in the fall, we'll be trying to support young researchers in doing more of this work. So details for that will be coming later. But we hope that we'll be able to provide a platform for academics and practitioners that are interested in this topic to keep moving it forward. So thanks for your interest.
Yes, I would like to say as we close, thank you so much for your engagement in the chat. I think this chat was just an exceptional discussion, and I really mean it. I have not seen debates and discussions like this happen often in webinars, so I really wanted to say thank you so much. Thank you for joining us today. We would love to keep you engaged with Arketa Institute going forward. We would love for you to sign up for our newsletter if you haven't already. So that's also a way for us to be able to reach out to you. And please don't be shy and reach out to us and email us if you want to speak to us in person or if you want to have us come and talk with your organization. I would say that from the classroom, and we've had students with us today, to the boardroom, we're happy to engage on these topics to really normalize these ideas and the topic of ecological economics and this field and how a post-growth economy can function, and especially the role of financial markets and capital markets in this sort of new idea, in this new economic system. So with that, I would like to thank all our speakers and everybody who tuned in today. And we really hope to be hearing from you today. And that concludes the webinar. Thank you.